If you're going to trade off of the president's tweets, you're going to get quite a headache because that thing just whipsaws all over the place. Fact of the matter is, the administration's been clear on their position on China ever since they put out the June position piece on Chinese economic aggression and what it means globally. So he's playing this thing out. He wants them to start to acquiesce on some of these major issues, intellectual property and just the way they run their corporate structures. And he's playing hardball.
Are these just one-day phenomenons, though, in the market, or 1 or 2 day deals?
Today is absolutely one day.
The Dow's up like 700 points since the tariffs went into effect on China.
No
so how
question.
much can the market truly care?
Well, it's not that they don't care, but it's just one of many factors. So you look at it from a short-term trading perspective, but really until August 30th, all of this is in play as we just go through these negotiations and try to figure out really where the rubber is going to meet the road.
And what the economic damage is going to be, Stephen. Does the market have it right on the trading around these trade headlines?
I think markets have it more right than economists at the moment. If you think about collecting $20 billion from the Chinese and then having a retaliation of an equal amount, you could scale that against a $20 trillion U.S. economy, and it doesn't seem like much. But when you scale it against $1 trillion of large cap profits, and the reality that companies have fixed costs, they have important supply chains that they rely on, their business can be lost, it can go to someone else, this can have a bigger effect on profits. And so the reaction that we see in financial markets, unfortunately having to be very reactive to trade issues, is an unfortunate new element of risk in the marketplace. And it isn't just, as it wasn't just aluminum and steel tariffs, it's what happens next. Will we have autos tariffs applied to European companies, Japanese companies? Where does exactly this end? And with retaliation, you're dealing with a lot of different potential players.
Rick, I wonder what it is that's going to get the market out of its range. I mean, not only from a stock standpoint, but bond yields too. I mean, look, the 10-year is just sitting 285, 286. What gets it and stocks to get out of that current range?
I think when it comes to the stock market, I think it's going to stay in this range for a while. We know what the bottom and the top is, and it always seems as though there is a story on trade when we do get a correction. It's always going to be something. But I think Treasury is a completely different animal. I think Treasury yields are affected by fundamentals, but there's so much more. So today we have a hot PPI, and I understand that PPI, whether it's here or in Japan, it doesn't mean the same as CPI. We did have a year-over-year 3.4 core today that we haven't seen in over 6 years, and we'll see how CPI looks. But there's so many other turnstiles that affect yields, and those turnstiles are mostly buyers pushing yields down. Overseas relative value, when you compare other yields of big sovereign developed economies to ours, pretty much whether it's in Japan, in Europe, they're lower. And also, balance sheets of central banks have manipulated rates to a point where they're not as responsive. They don't send out the same smoke signals. So I think the range-bound Treasury is going to remain. Ultimately, there's going to be something in the inflation data or some of the preferred gauges where maybe some red lights will flash. If you recall, at the beginning of the year, we had a wage year-over-year gain of 2.9 that seemed to elicit a big response. It was later revised away. So I think there can be an issue there. But for the most part, I think these markets are very comfy in these current ranges.
I mean, Stephen, Rick is right to point out the PPI, producer price inflation, yes, it's at the wholesale level versus consumer inflation. But there's this idea out there that the Fed isn't going to be able to raise rates very fast or as much as originally thought because of the trade war. Is that true, given some of these inflation data that's coming out?
That's a particularly hard call for the Fed at the point where domestic inflation pressures are not tremendous. But there is some underlying upward movement in inflation. There are some capacity constraints eventually binding on the U.S. economy. And when you have maybe another 2 years of solid growth left in the American economy, and you don't know where you will end on the tariff front, there is going to be some cost issues. And whether consumers will absorb that or not, that's really an issue, a question that the Federal Reserve, it's a trade-off against real economic growth. That may produce somewhat higher prices and weaker economic growth.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.